Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Phil Nadel of Forefront Venture Partners. Phil, thank you for joining us.
My pleasure, Hall. How are you?
Oh, we're doing great here and looking forward to talking with you today. So what was your background before investing in early stage companies? What led you to the work you're doing today?
Well, I was a serial entrepreneur for many years, started a number of companies and was fortunate enough to have some really nice exits. And I found that when that happened, I was being approached by friends and family who were looking for investments and advice into their companies, their startups. And so my startup investing career sort of got started by investing in businesses of family and friends and helping them and advising them. And I really enjoyed doing that and decided after a while to expand that, to do it more full-time and really to focus on that. And of course, to broaden the scope beyond just friends and family who are starting businesses, but to really look beyond to the general market. So that's how I got started.
Well, great. So for those investors who are out there just now starting their journey down the path of investing in startups, what would you advise them to think about or do before they make that first investment?
I think it's really important for new investors in startups to invest alongside or with experts, people who've done it before, people who have experience. There are a lot of pitfalls out there and there's a lot to learn. And I think the best way to learn is to invest alongside someone who has the experience and who knows what they're doing. So that would be, I think, the primary thing to focus on. But also, I think no matter what, I think it's really important as an investor to ask a lot of questions and really be curious. And I think that's a trait that, although when I was a kid, it drove my parents crazy, but it's something that has served me well as an investor in terms of asking a lot of questions and really digging into the details. I find that at a surface level, a lot of founders can tell a good story, but fewer and fewer of them can tell as compelling a story when you start to dig deeper into the details. So I think that's really important too.
Well, that's good advice. So you see a lot in the early stage investing world. How do you see the industry evolving these days? What are the changes you see coming up?
Well, there's a lot more capital today chasing deals, chasing startups in particular than ever before. And so there are a few things to consider there. One is that you really, as an investor, can be much more selective because there are a lot of deals, but because there's so much capital chasing deals, you want to be selective. You don't want to just jump in with any deal. But valuations, because of all this capital, valuations are really getting kind of lofty. And I would be cautious about that. And I think especially so in some of the primary markets, Silicon Valley and New York. And we do invest in those markets, but we really find a lot of better valuations in the secondary and tertiary markets. So we're geographically agnostic, and it really, I think, benefits us to have that kind of a wide lens because, again, the valuations on some of these deals just don't make sense. And I think that's a reflection of a lot of capital in the market today.
Well, it sounds like valuations is a key part of your investment thesis, and I agree that's a really critical point. But in addition to valuation, what else do you have in your investment thesis, or what do you look for in startups that get you excited?
Well, the number one sort of filter that we apply is we only invest in post-revenue companies. And we've done a lot of analysis on this and found that there's an inflection point when it comes to that risk-reward slope or that chart, if you will. And the increase in risk that pre-revenue companies have, the increased risk profile, we feel is not commensurate with the increase that an investor would get in the reward. So we'd rather wait until they're post-revenue and pay a little bit higher valuation, but have it de-risked in a much more significant way. So that's number one. Of course, it sort of goes without saying, but I'll just say it anyway, that we invest in great founders. I mean, at a startup stage, an early revenue company stage, investing in the founding team is the number one thing. So we're really focused on that. Because we are not a typical venture fund, we're one of the largest syndicates, we really focus on building a diversified portfolio. So some funds and some investors really are focused on a particular segment, a particular industry. We intentionally do not do that. We think it's important to be diversified. We're big believers in portfolio theory, and a diversified portfolio is very important. I mean, sectors can get hot and can get cold, and that means that financing and exits in those sectors also get hot and cold. So that can be a danger in focusing on a particular sector. And also, if you focus on too narrow of a sector, you end up looking at a limited universe of deals. So we like to really look at a broad range of deals and build a diversified portfolio. So we invest across different sectors, different business models, even different stages, mostly in the seed and A round stages, but can be anywhere from $20,000 a month in revenue to $350,000, $400,000 a month in revenue. So kind of a broad range there.
Would you have a couple of startups that fit that thesis?
Well, yeah, we sure do. We have our whole portfolio, but some of the recent deals, company we're just investing in right now is called Blue Dot, and they have the most accurate location-based system in the world. It's not only the most accurate, but it has the least battery drain. So like if you compare it to GPS or geofencing, it's 20 times more accurate with much less battery drain. And they have Fortune 500 customers from McDonald's and Dunkin' Donuts to Transurban, all kinds of very interesting use cases. So that's a really fascinating company with great technology. We have another company on the B2C side, just as an example, which is called Boundless. And they're taking a very complex process, which is applying for immigration to this country, and making it much simpler for people. So I've never been through personally the government's process for applying for immigration, but I've gone through, seen it with other people, with friends and people I know who've gone through the process, and it is extremely complicated and time-consuming and confusing. And many times people who apply get denied. And so what Boundless has done is they've simplified the process, and it's very, very affordable, but they also just make it very easy. And so far, they've had just a fantastic acceptance rate and approval rate from the government. They're actually at 100% so far. So that's another example of a type of company. And both of those companies, by the way, are founded by just really, really smart people who are the founders who are just know the market in and out, are really ambitious go-getters, and the kind of people you want to invest in. Almost regardless of the type of business that they're in, these are the kind of people you want to invest in. So those are a couple of examples.
Well, those sound like great startups for sure. So as you look at this space, what do you think are the main challenges startups face today? Is it regulatory? Is it market? Is it technical? Or is it all three?
Well, I think, going back to a point I made earlier about the amount of capital out there. So these days, it's cheaper to start a company than it ever has been before, right? You hear that a lot. The ability to outsource a lot of things and to get cheap cloud computing, and it's just much cheaper to start a company. Plus, you have a lot of capital chasing deals. So you have an abundance of capital, and you have a low-cost barrier to entry to start companies. So as a result, there's more competition than ever. And finding pockets of innovation or differentiation in startups is challenging. So for startups to find an area that they want to focus on, an area that where they feel they can have some differentiation or build a moat, has become increasingly challenging because of all the competition. And so one byproduct of that is that customer acquisition has become more expensive. So that's one area where starting a company has become more expensive, as opposed to the technical side where it's cheaper. Customer acquisition in a lot of cases has become more expensive. And we always look at paid customer acquisition channels and strategies and what the costs are. But the companies that are doing really well are building a lot of referral and organic sources of traffic and of customer acquisition that are not paid, that are free sources or very low cost. And again, that's just a result of the competitive space that we're in right now.
Well, that's so very true. We see that quite a bit out there as well. The chance that you'll get that website up and running is pretty clear, but will you get somebody on it using the software? That's really the key part these days.
Well said, exactly.
Right. So if you had to pick a couple of subsectors or applications out there in the market that you think are ripe for innovation for startups to pursue, what would you call out today as good applications to go after?
There are always problems to be solved, right? That's what entrepreneurs do. We solve customer problems, and you can always find inefficiencies or problems that need to be solved, processes that can be made better. And so I think that companies want to focus on solving a real problem. We like to see companies that are capital efficient and differentiating in some important way. But to be specific in terms of sort of sectors or technologies, I think there are a lot of opportunities for smart deployment of artificial intelligence, right? That AI is thrown around a lot as sort of just a catchphrase, but there are a lot of really smart ways, innovative ways to use AI we're just getting started in that. So I think companies that are using that, using artificial intelligence in a smart way, I think that there are also opportunities, again, strategically in robotics. We're just at an early stage there. We're seeing sort of industrial robotic usage increasing dramatically. And I think that'll start to trickle down to some smaller companies as well. And on the other side of things, I think there are a lot of industries or sectors where still the vast majority of commerce is occurring offline, where it could be transitioned online. So especially with new technologies that make online shopping easier, even for some products that have traditionally just been purchased offline, I think there are opportunities in e-commerce in sectors that haven't been online as much. So I think those are a few areas where there's a lot of interesting opportunities. And of course, we do a lot of SaaS as well, and there are always interesting opportunities for B2B SaaS applications in niches and different sectors that, again, are simplifying processes or aggregating data in interesting ways.
Well, those sound like some great opportunities and applications. So in the last few minutes that we have here today, what else should we cover that we haven't?
Well, I think we covered most of it. I guess I want to emphasize a few things. And that is, I want to go back to the point of investing with experts when you get started. Part of the value add or the benefit that we offer to our syndicate investors is that we've been doing this a long time and they can invest alongside of us. So I think that's a good way to get started. I think it's also important to keep in mind that as an angel investor or an early stage investor, I think it's really important to be helpful to companies. Capital is readily available. You want to have some additional value add that you can bring beyond just the capital. So try to be helpful without being intrusive, and helpful with introductions and advice and whatever the company is in need of. And I think that, just to mention one other point, we're always big fans of transparency and regular communication. And we like it when companies are communicative and communicate regularly with their investors and are transparent in terms of their financing and their financial performance. So before you get into investing in a particular company, I think it's important to sort of discuss that with the founders, get a look at some of their previous investor updates, and make sure you're comfortable with the format, the cadence, the amount of disclosure you're getting, and those kinds of things. Because this is a company you're going to have to live with for 5-10 years or more sometimes, and you want to make sure that you're getting communications from them that you're comfortable with and that you won't be frustrated by.
Well, those are good points. So how best for listeners to get back in touch with you?
They can go to our website at forefrontvp.com, and we're certainly very active on AngelList. That's where we run our syndicate. So they can go on AngelList and look up Forefront Venture Partners, or just through LinkedIn. We're all over social media as well.
Well, great. Well, we'll put those in the show notes and hope to have you back for a follow-up soon, and want to thank you for your time.
Oh, I appreciate the opportunity. And just on a personal note, I really appreciate everything you do for the startup world. Thank you.
Well, we appreciate that as well. Thanks so much for your support, and looking forward to catching up.
Take care now.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.